Hey traders, Mike Sir here. In my past videos, I profiled many successful hedge fund managers, but there's only one hedge fund manager who is considered a pioneer in the hedge fund industry and a legend in the trading community. Now, he was profiled in 1987 in the classic documentary called Trader, which took viewers inside the high-stakes world of futures trading. It was this documentary that I would later watch in the 1990s that would lead me to a path in the financial markets. So in this video, I'm going to profile one of the most successful traders in the past century. His name is Paul Tudor Jones. Let's get started. Paul Tudor Jones is an American billionaire who founded one of the most consistent and top-performing hedge funds of all time, called Tudor Investment Corporation. Now, his fund has provided an average annual return of approximately 19% since the fund's inception and has hardly ever had a losing year. Now, with that type of track record, his firm attracted a lot of investor capital, and as of 2020, Paul Tudor Jones Tudor Investment Corporation had hedge fund assets of almost $10 billion. However, his claim to fame was in October 1987 when he noticed a similarity between the 1929 crash and anticipated the market crash referred to as Black Monday. He bet heavily on the downside using large short futures positions, and he would end up tripling his money on the trades and end that year making a 126% return after fees for his investors. For those who want to learn more about Black Monday, I made a video of a trader who also won big on that day, and I'll include it at the end of this video. Before I share the details of Paul's trading strategy, please take a moment to like this video. I would really appreciate your support. Paul's trading is more of a global macro trading style, meaning that he looks at the markets on a macroeconomic level and focuses on the overall economic and political situation in various countries. However, he bases his entries primarily on technical analysis with an emphasis on momentum factors driving prices. But what Paul really excels at is the ability to spot market reversals and strives to buy and sell stocks at key turning points in the markets. And this is where he says the best money is made, as he catches a lot of tops and bottoms in the market. Now, Paul trades a lot of different asset classes, but primarily trades the futures market because it's the market that he's most familiar with and the market that he got his start in. Now, I'm not going to go into more detail about his exact trading strategy in this video, but rather talk about his trading philosophy instead. It's his approach to trading that I've learned the most from him and that I will share with you guys next. Some of you may have heard of this saying, sometimes the best defense is a good offense. Now, my interpretation of this is that sometimes to win, you just need to make sure that you don't lose. Now, Paul uses the same analogy for trading as he believes that traders should focus their attention on playing a defensive strategy while trading. And this means that traders should be patient in waiting for the right opportunity to trade rather than try to trade all the time or keep on scanning for potential good trades and make the mistake of entering too early. Now, this is an offensive strategy where the goal is to try to make money every single day and try to capture all the trading opportunities in the markets. I don't think it's wrong to have an offensive strategy, but the key is what Paul says is that there will always be a lot of great opportunities in the markets, and there's no need to rush into every trade that you see or rush any trades, especially if you haven't done your trading plan yet. You've probably heard about this from me many times, and that is risk is always your number one priority in trading. It's the same with Paul, as he never thinks about what he might make on a given trade, but only on what he may lose. Now, for Paul, he believes that the most important trait in a trader is how good he or she is at controlling risk and minimizing losses. In fact, he thinks that 90% of any great trader possesses strong risk management skills. The simple reasoning is that no trader can control how much money he or she makes, but they can definitely control and manage how much they could potentially lose. When Paul is trading poorly, he keeps reducing the size of his positions that he's playing. So for example, if he's playing with 10,000 shares on each trade and his trades aren't making money, then he starts playing with 5,000 shares. And if he still keeps losing money, then he'll keep reducing the size of his trades. And this is so that he can minimize his potential losses, especially when he's on a losing streak. You see, most amateur traders feel the need to make back their losses, especially after a losing streak, by trading bigger position sizes. But if you logically think about it, it doesn't make sense to risk more of your money when your previous trades aren't working. The right thing to do is cut down the size of your positions for a while and avoid taking risk until your trades are back in sync with the market. This is Paul's defensive strategy approach. Sell your trading positions first whenever things don't look that good or are not profitable. When things are not going as anticipated, you shouldn't hesitate to sell off your trade positions as soon as possible. In addition, don't worry if you made the wrong decision on selling or getting out too early, because the great thing is you can always buy back in when things look strong again. Now, what some amateur traders do is once they commit to selling their position, they hesitate to get back into the same trade because they fear they will be wrong twice. And especially once the trade works in their favor, they feel that they had already missed that opportunity. But what the market is really telling the trader is that you're right, now it's a safe time to buy. Paul is a big believer in trading psychology, which is why he works closely with Tony Robbins, one of the most successful life coaches in the world. In fact, Paul pays Tony $1 million a year for Tony to help him with his mental trading mindset. Now, Paul loves how Tony can deconstruct what drives certain behaviors and help him develop a plan for action with carefully considered risk and reward propositions. Now, after Paul had a lot of success in the markets in 1987, he struggled in the following years. And a few months after meeting Tony, Paul decided to see if he could help him with his trading performance. Now, what Tony does best is take an approach where he helps his clients discover what works and what doesn't for their performance without needing to match their level of expertise. So, for example, Tony discovered that there were patterns that Paul was doing when he was at his very best in trading, and he had dropped them out. A crucial habit that Paul had abandoned was asking himself if he had a chance at a 5-to-1 return for every dollar invested. The simple reason why this was so important was because Paul only looks for big risk-to-reward trades. After working with Tony, Paul started having success with trading again, and ever since then, Paul has never had a losing year. In addition, one other psychological mind hack that has helped Paul with his trading is he likes to spend his day making himself happy and relax. So the question I want to ask you is, can you remember a day when you were very upset and happy? And ask yourself, did you make money on that day? There are so many of Paul's trading lessons that I want to share with you, and I'll share them in the next video. I'll end this video with a quote from Paul that almost every experienced trader has faced in his or her trading career. Thanks for watching. If you like this video and want to watch other videos where I profile the top traders in the world, please click on the left for another trader profile video, and also click on the right for my top trader profile playlist. I'll see you on the next video.